I hear that concern from investors and question quite often. Interest rates have been on a steady decline for the past 40 years. And often investors expect that since they are now near these 40-year lows, when they imagine future scenario, they think about the mirror image. We assign quite low probability to such development. We think that since rates bottomed in 2012, 10-year yields in US have actually been trading in a 1.5% to 3% range 95% of the time. So that's quite a well-contained range at the bottom. It's good to remember that there are historic reasons why interest rates have come to these lower levels, and they may stay at lower levels for an extended period of time. Two of these reasons, to give you an example, would be that central banks have been pursuing the inflation targeting policy and have actually tamed inflation quite well. And the second reason would be demographic, especially in developed market countries. Aging population mean also that growth and inflation potential is lower. But that's historic perspective. But when we think about interest rates, we also think about geographic perspective. So when we look at Barclays global aggregate bond universe, 20% of bonds in that universe trade with negative yields, mostly Japanese and European bonds. But when you are a North American investor and you invest into these securities on a currency hedged basis, your yield actually is higher than Canadian or US yield in many cases. And that's going to be the case as long as short-term rates in Canada and in US stay higher than Japanese or European rates. We expect that to continue for a while. There is also another example that combines these historic and geographic perspectives, and that's an example of Japan, where 10-year yields have been below 2% for 20 years. And only once during these 20 years, Japanese investors in bonds had negative total return during that year. So while questions about the role of fixed income in portfolios and the future path of interest rates keep popping up, we believe that as long as inflation remains under control, fixed income is going to play an important role in investors' portfolios. Interestingly, I think actually there is more opportunity to generate alpha in fixed income now than at any time during the past 20 years. Even if you look at just the decade since financial crisis, the fixed income market has increased both in breadth and depth. If you look at the outstanding stock of global government and corporate bonds, it increased by $60 trillion. That's 3 times the size of the US economy. That's a lot of choice. In addition to that, the number of issuers in the global fixed income markets doubled over that decade to over 22,000 issuers. When more currencies are floating and freely tradable, and cost of trading both in fixed income and in currencies has declined. So with the right amount of resources, with deep analytic team, we believe that active investors can make important decisions that are going to contribute to value added and alpha in fixed income portfolios.